October 1929. Wall Street is collapsing. Men in expensive suits are staring at numbers they can barely understand. Fortunes built over decades are disappearing in hours. Banks are panicking. Investors are selling everything they own. And within weeks, the story seems obvious. The stock market crashed. Then the Great Depression began. Simple, clean, and mostly wrong. Because the crash of 1929 did not create the economic disaster that followed. It exposed it. The real crisis had been building quietly for years, hidden beneath rising stock prices, booming factories, easy credit, and the illusion that America had entered a new age of permanent prosperity. The Great Depression was not caused by one bad day on Wall Street. It was the result of a system that had become dangerously fragile. And when one part finally broke, almost everything else followed. To understand what really happened, we need to go back to the decade before the crash. The 1920s are often remembered as the Roaring Twenties. Cars filled American streets. Radios entered millions of homes. Factories produced goods faster than ever before. Electricity transformed cities. New technologies created entire industries, and the stock market seemed unstoppable. Between 1921 and 1929, American industrial production expanded dramatically. To many people, this looked like proof that the old rules of economics had changed. Prosperity was no longer temporary, it was the future. But there was a problem. The prosperity was not distributed evenly. Factories were becoming more efficient. Companies were producing more goods. Corporate profits were rising. But the purchasing power of ordinary families was not growing at the same speed. This created a dangerous imbalance. America could produce an enormous amount of products, but eventually someone had to buy them. At first, credit solved the problem. Americans began purchasing cars, radios, refrigerators, and other consumer goods using installment plans. Buy now, pay later. It felt revolutionary. Families no longer needed to save for years before purchasing expensive products, but credit does not create income. It moves future spending into the present, and once millions of families had already borrowed to purchase the products they wanted, demand began to weaken. Factories could still produce, but consumers could not continue buying forever. This was the first crack. The second was even more dangerous. The stock market had become a national obsession. Ordinary Americans watched stock prices rise and began to believe they were missing the greatest opportunity of their lives. But many didn't have enough money to buy stocks directly, so they borrowed. This practice was called buying on margin. An investor might pay only a small portion of a stock's price with their own money and borrow the rest. As long as stock prices continued rising, the system looked brilliant. Imagine buying $1,000 of stock using only $100 of your own money. If the stock increased in value, your gains could be enormous compared to your original investment. But leverage works in both directions. If prices fall, losses become much more dangerous. And by the late 1920s, enormous amounts of borrowed money were flowing into Wall Street. Stock prices were no longer rising only because companies were becoming more valuable. They were rising because people expected prices to keep rising. People bought because prices increased. Prices increased because people bought. The market was feeding itself. But underneath Wall Street, another crisis was already spreading across America. farmers were in trouble. During the First World War, European agriculture had been devastated. American farmers expanded production to feed international markets. They bought more land. They purchased machinery. They borrowed money. For a short time it worked. But after the war, European agriculture recovered. Global demand for American agricultural products weakened. Prices fell. And American farmers were left with debts created during better times. Throughout the 1920s, thousands of farms struggled. Rural banks began failing. Long before Wall Street collapsed, parts of America were already experiencing their own depression. The economic boom was real, but it was sitting on top of multiple hidden crises. Then came the international problem. The First World War had completely transformed global finance. European countries had borrowed enormous amounts of money. Britain and France owed money to the United States. Germany owed reparations to the victorious European powers. But Germany struggled to pay, so American banks lent money to Germany. Germany used that money to make payments to Britain and France. Britain and France then used the money to repay debts to the United States. Look closely at what was happening. American money was traveling to Germany, then to Western Europe, and then returning to America. The entire international financial system had become a circular flow of debt. It worked only as long as American credit continued. If American lending stopped, Germany faced a crisis. If Germany stopped paying, Britain and France faced a crisis. And if European economies collapsed, American businesses lost important markets. The world economy had become connected, but it had not become stable. Then, in 1928 and 1929, American monetary policy began tightening. Officials were increasingly worried about speculation on Wall Street. Interest rates rose. A credit became more difficult. The flow of American money overseas weakened, and the fragile international system began to feel pressure. Then came October 1929. Stock prices fell. Investors panicked. Margin buyers faced devastating losses. Brokers demanded money from investors who did not have it. Those investors were forced to sell. More selling pushed prices lower. Lower prices created more margin calls. More margin calls created more selling. The cycle accelerated. Billions of dollars in market value disappeared. But even now, America was not automatically destined for the Great Depression. Stock market crashes had happened before. Financial panics had happened before. The real disaster came from what happened next. Fear spread from Wall Street into the banking system. At the time, the United States had thousands of banks. Many were small and vulnerable. There was no modern federal deposit insurance protecting ordinary customers. If your bank failed, your savings could disappear. And people knew it. So, when rumors spread that a bank was in trouble, customers rushed to withdraw their money. This created a brutal paradox. Even a bank that might have survived under normal conditions could collapse if enough people demanded their money at the same time. Banks do not keep every deposited dollar sitting inside a vault. They lend much of it. That is how banking works. But during a panic, everyone wants cash immediately. Banks were forced to sell assets. Loans disappeared. Businesses could not borrow. Families could not access credit. And as banks failed, the money supply contracted. This is where a financial crash became something far worse. Businesses saw sales falling. Credit was disappearing. So they cut production. Then they fired workers. Unemployed workers spent less money. Lower spending hurt more businesses. Those businesses cut production again.